Mining is the bedrock of the African economies. Although African consumers will be a key growth factor, the continent's natural resources, particularly oil, will remain central to many countries. Resource-rich countries are benefiting from stronger global demand in the aftermath of recession, driven in particular by the burgeoning appetites of India and China for minerals and energy products, which is boosting commodities prices. Higher commodities prices, in turn, are driving investment in exploration and extraction. Oil has been the main focus of major foreign direct investment, or FDI, but key minerals such as gold, copper, chromium, iron ore, and diamonds, and more exotic elements, are major draw cards as well. Most notably, new junior mining firms, which tend to be more dynamic and responsive, are playing a key part in the investment surge. However, mining firms, whether big or small, will continue to face several obstacles, ranging from weak or non-existent regulations in some countries, for example in the DRC, to over-regulation in others, such as the overly restrictive BEE laws in South Africa. Land disputes and infrastructure bottlenecks will also be a burden in the future. Another key area that is part of Africa's growth story is regional trade blocs. Regional integration is advancing in Africa, despite many stops and starts, offering the hope of larger markets, fewer barriers, and potential economies of scale. Proposals for single African trade zones will, however, still take time to be realized. The main blocs are the SADC in the south, the EAC in the east, COMESA in East and South Africa, and the ECOWAS in West Africa. The main obstacles are non-tariff barriers, incompatible regulations, clashes over common external tariffs, and weak infrastructure connections. Cross-membership of trade blocs is also a further problem, as they are integrating at different speeds. The EAC is moving the quickest and introduced a common market back in July 2010, but the impact will be gradual as many laws still need to be harmonized. And Tanzania has preserved some of the opt-out options. Proposals for a unified trade bloc comprising the SADC, for example, COMESA, and the EAC are advancing, but they will take several more years to be fully realized. The EAC had a fast-track program for the introduction of a single currency back in 2012, but given the need to harmonize fiscal and monetary policy, 2015 seemed like a more realistic deadline. The UEMOA in the West and the CEMAC in Central Africa, as part of the Francophone, already have single currencies linked to the euro. Foreign direct investment. Foreign direct investment has been picking up in Africa over the last few years. Interest is rebounding, and several major deals have been concluded or are in the pipeline. Telecommunications and banking remain the biggest non-commodity draws for foreign investors, and the trend is likely to continue. But retailing is on the rise, spurred by urbanization and the rise of the modern African consumer. For example, in June 2011, Massmart, a South African retailer, concluded the sale of a 51% stake to Walmart, the U.S. retail giant, for $2.4 billion after a lengthy battle with regulators, mainly because of trade union opposition. Walmart's aim is to use Massmart as a launchpad into the wider African markets. The main deal in 2010 was Bahati Artel's purchase of Zane's African assets in 15 countries for $10.7 billion, one of the largest ever investments in Africa and certainly the biggest from India. As expected, a fierce price war has ensued. Of course, these sums just represent initial investment, and most firms will continue investing to build their market position. South Africa is one of the key gateways to the rest of Africa. Most African markets are open to FDI in telecom and banking, albeit with restrictions in some cases. Ethiopia allows FDI in neither sector, which is impeding innovation. China. China has emerged as a leading investor in Africa, not only in the resource sectors. China's rising trade and investment links to the continent will remain a very important contributing element of Africa's growth story in the long term. Although resources have been the initial big investment on the continent for China, rising from $681 million in 2000 to $9.3 billion as recently as 2010, there has also been a shift into services, and the sector has taken the largest chunk of investment. In addition, the next few years will see the development of industrial parks in key African countries. One industrial park is already operating in Mauritius, and more planned in Nigeria, Ghana, South Africa, and Kenya. The aim of these parks is to improve infrastructure and the regulatory environment, and to encourage Chinese firms to establish manufacturing industries in these parks, as they benefit from the tax break holidays, favorable regulations, and good infrastructure. Trade between the two continents has also been rising. 12.4% of all exports from African countries went to China, a 15-year increase since 2001. Angola is the leading supplier of oil to China, followed by Nigeria. There has been a real shift in the last decade, and South-South trade is taking increasing importance. One key issue that has arisen is whether or not it is the responsibility of Chinese investors to develop the skills and provide education, or is it the responsibility of the African governments to develop the skills needed in order to create the opportunities and the jobs and the growth. Based on trends to date, both the governments and the investors, whether they are Chinese or other international operators, will need to invest in education, skills, and infrastructure. If not, as in Europe, history will repeat itself and show that the transfer of skills and development of human capital will remain one of the biggest challenges in Africa. This is something, however, that Indian investors are addressing to some extent. As part of their African strategy, which is to secure resources, efforts to transfer skills on small scales are taking place. If left unchecked, the prospect of an African Spring cannot be discounted. Key risks of doing business in Africa. But despite all the enormous opportunities, there are still risks, both economic and socio-political, for doing business on the African continent today. The key economic risks range from weak fiscal and monetary policies, high inflation, volatile currencies, high taxes, nationalism issues, skill shortages, and inadequate infrastructure and red tape. With regard to inflation, inflation has now returned to levels recorded before the commodity price spike during 2007 and 2008. In sub-Saharan Africa, the average rate of inflation jumped from 11.7% in 2008 on the back of soaring oil and food prices, but retreated again to 8.5 in 2009 as the global downturn curbed price pressures. The annual average rate was around 7.1% in 2012. However, inflation will remain comparatively high in a global context and will be vulnerable to fluctuations in commodity and product markets. The ongoing power crisis, severe infrastructure bottlenecks, and higher tariffs will also have an impact on inflation across the African continent. In the next edition of Africa Open for Business, we will consider the rise of Egypt. As Egypt emerges from the economic downturn of the Arab Spring, her president and her people face new challenges as they work not only to return the country to standards they were used to prior to 2011, but also to reach beyond them with new plans for economic growth and development above and beyond the traditional sectors like tourism. Be sure to join us. This program is sponsored by BaysListed.com World Classifieds. You can post the same ad to the same category in multiple cities across the USA at the same time, exposing your ads to extensive market reach nationwide. Visit the site today. Go to BEYSLIST.com right now. Thanks for watching. Take care.